Hello and welcome to LedgerCast. My name's Brian Krogsgaard. Rolling solo today. Josh is moving furniture, but we've got some great guests on with me. It's the co-founders of the 0x project, Matcha. We're going to talk about all of it. Before we do, thanks to Token Sets. Go to ledgerstatus.com/sets to check it out. They're actually a user of the 0x API and protocol. You can do asset management directly on Token Sets. They've got the DeFi Pulse Index, the leveraged ETH stuff through FLI, and a bunch of other strategies that you can use and check out there at Token Sets. Thanks to Token Sets for being a great partner. Go to ledgerstatus.com/sets. Now, let's get to the meat of the show, and that's to be joined by Will and Amir, people I've wanted to talk to for a very long time, the co-founders of the 0x project, in charge of Matcha and other stuff. We're going to learn the whole structure, the corporate and organizational structure there. Hello, how are y'all doing?
It's good. Yeah, thanks for having us, man.
Oh, man, it's a true pleasure.
Yeah, same. And yeah, thanks everyone for tuning in.
Yeah, it's great to have you with us. So y'all started 0x back in 2017. It's been a heck of a journey. Back then, there was some talk about trading on chain, about DEXs being the future, and then it took like 3 years for it to become quasi-real. But today we're seeing DEX volumes competing with the top centralized exchanges in the entire world. So that's got to feel pretty good. Amir, why don't we start with you and just kind of get the origin story on how you and Will got together and how 0x came about.
Sure. So my background is actually in trading. So I started my career at a prop trading firm called Chopper Trading, and later we got acquired by a larger firm called DRW. Kind of originally got into crypto and Bitcoin from the trading angle. There was just a lot of excitement around the first big run up in like 2014, I think, and had a pretty close group of coworkers who were all just kind of watching it together. But as time went by, I just fell deeper and deeper down the rabbit hole, and was pretty convinced that crypto was the future. And in 2016, learned about Ethereum. Just really blew my mind, and decided that I wanted to get out of trading and get into the crypto space full time. So around that same time, I'll let Will share his story, but one of my coworkers and good childhood friends with Will introduced us, and kind of hit it off from there.
Nice. Will, how'd you get into it?
So I read about Bitcoin, I think on Hacker News, I'm not quite sure when, but it was like quite a ways back, and thought the technology was really interesting, and kind of kept following it. And my wife, who was my girlfriend at the time, was also like really interested in Bitcoin, and she actually ended up joining Coinbase pretty early on. And so like through Linda, my wife, Linda, being at Coinbase, I my natural interest in it, I got, to learn more and more and kind of get closer to the space. I was doing engineering in undergrad, and then I went into a PhD program for engineering at UC San Diego. And I was kind of on like a research track. I was working at a government lab called Los Alamos for a couple of years between undergrad and grad school. But when I was in grad school, I just became even more interested in crypto. I was like mining Bitcoins in my dorm room because we had free electricity. And I had to wear like earplugs because it was like too loud. I couldn't sleep. But
you just stuck with like GPU rigs or something?
No, I actually bought some like used ASICs.
Oh, wow.
I think they were called like Spondulis. I don't think the brand even exists anymore. They're relics of the past.
Hilariously loud.
Very loud, very hot. Yeah. But yeah, then Ethereum came out, and it felt like the most important invention since the internet to me. And so I was kind of just like hacking on Ethereum smart contracts in the evenings. And then eventually it just like decided I needed to pursue Ethereum full time. And so I dropped out of the program and moved to San Francisco. And yeah, I met Amir pretty shortly after.
That's cool. Yeah, I actually had a very similar origin story of hearing about Bitcoin. It was all over Hacker News stuff back in 2012, 2013. It was a big bull market that was kind of kickstarting back then. I made the mistake of not really digging in heavily enough back then because I just thought of it as like internet money, like that was transactable. But it took me realizing that Ethereum was a thing, which I didn't realize Ethereum was a thing until like it started to make more retail awareness. So like when it was 2015, 2016, I had no idea. But the programmability of a blockchain is what really got me excited as a web developer to realize that there was a lot more that exists on a blockchain. So that's why it took me until 2017. And then y'all were one of the first projects that I really sunk my teeth into of like researching fundamentally, figuring out what it was. And you were just releasing some of your earliest code, I guess, like mid 2017, and you had this plan of being kind of the rails of trading and exchange on chain. How long did it take y'all to develop that vision that like actual activity would occur and that it needed kind of this API base layer that became 0x?
So it wasn't like we had like some like light bulb go off and it was just like, oh, like we predict the future. We see this like need for this. We actually kind of figured it out over time by interacting with other teams that were building stuff in the Ethereum community. So when Amir and I initially started working together full time, this was October 2016. And we were building a decentralized exchange. We have like this core thesis that like all forms of value are going to end up tokenized on public blockchains. So everything like traditional assets like stocks, bonds, fiat currencies, things that are like more abstract, like reputation and attention can be digitized. Things like, airline miles, video game items, all that, everything. And so that was kind of like our core thesis. But when we first started working together, there just wasn't really a decentralized exchange out there. And so we started working on building one more so as like our kind of like our own standalone decentralized exchange that we were going to build as like, it's just a product and, it would be like a for-profit venture.
Yeah.
But as we spent more time at like Ethereum meetups in San Francisco and meeting with teams like Augur, Gnosis, Maker, tons and tons of projects, what we found is that like every single one of these projects required exchange functionality in order to work. But exchange wasn't like the core focus for the project. It was just like, oh, well, we need this in order to like
some kind of on-site swap from one token to another so that you could use the app or something.
Exactly. Like exchange is like a core part of what they're building, but their focus isn't the exchange component. It's really like, something that enables the true use case they're focused on. And so, all these teams were building their own kind of custom decentralized exchanges. Since we were only focused on decentralized exchange, we felt like we had like a really good, like technical approach. It was like really efficient. We'd put a lot of thought into it. And so our thinking was like, why have every single project create its own kind of DEX when you can just have like a piece of public infrastructure that like everyone plugs into. And if we build that, that's going to have like way more, like a way broader impact than if we were to just build a single standalone product. Yeah.
Makes sense. I want to hit pause for just a second because I just want to provide some disclosures. I've wanted to talk to them for a very long time. However, they have been sponsors of our podcast, I guess, for the past year. And then also may or may not hold 0x tokens myself at any given time. I don't give a crap about any of that. We're here to talk about the project. We'll talk about some of the token stuff and all that, but this is still just like a regular, normal episode of the podcast where I'm hoping to learn. There was no compensation or anything like that involved here, just in case anybody wants to put their negative hat on. Anyway, so I forgot to say that at the beginning. I think what I would love to know is how did y'all have to iterate as you started to realize some of this vision, and then when did it start to click? Because there was this relayer concept that existed for maybe 2 years, something like that, where people could build a relayer, but it was more of an order book style system. So how did you iterate, and when did you kind of change directions in terms of how you would provide support for DEXs?
Yeah, that's a great question. 0x has evolved quite a bit since the early days. So, as you mentioned, started out with purely this off-chain order book model where, there's this concept of a relayer, and they would just store these off-chain orders kind of like a bulletin board, and people could, pick out orders and fill them. But the relayers were not ever taking custody or anything like that. They were kind of they were essentially decentralized exchanges that could share liquidity with each other. Pretty early on, after we launched in late 2017, there were a ton of relayers. I think 0x was one of the first projects to go live on Ethereum mainnet. And I think there were just all these companies kind of waiting on the sidelines, all right, where's some opportunity for us to, build real products and interact with real users. And I think a relayer was one of the first things you could really build. So, there are probably 20 relayers within a couple months of us launching. Had pretty clear developer market fit, I would say. Through the 2017 ICO era, I think the relayers did fairly well for the most part. But then, when things kind of died, more of the trading activity, started getting concentrated in the main token pairs. There weren't kind of all these long tail random tokens people were trading. And what became clear is that liquidity was a real issue. The types of people trading on decentralized exchanges at that time were very ideologically bought in, but the pricing was still significantly worse than using a centralized exchange. Providing liquidity on a decentralized order book is a pretty big technical challenge, I would say, pretty big investment. And because the volume wasn't there, it was just hard to.
But you were making transactions essentially to establish where you existed on the order book, right? So you were saying, I want to sell at XYZ price, and you have to sign a message to do it or something along those lines.
Yeah. So you sign this off-chain message, and then someone could pick that up and submit it to the smart contracts, and the trade would be settled. But generally speaking, that model does require professional liquidity providers, but it was hard to onboard professional liquidity providers because the volume opportunity was not yet there. So we kind of recognized liquidity was an issue. And at the same time, there started to more decentralized exchange solutions started to pop up behind the scenes. Uniswap probably being the prime example. There's also Oasis DEX from the Maker team, and realized that from an end user perspective, like they don't really care where the liquidity is coming from. It would actually make sense to like aggregate all these things together and just like really simplify both the developer experience and kind of the user experience. So we decided to build an aggregation API on top of 0x that would not only tap into the 0x order books, but into all the other on-chain decentralized exchanges. And then from there, we had even more learnings. Like we realized that most of the consumers of the 0x order book liquidity were actually like bots, arbitrage bots for the most part. They were arbing the 0x orders versus the other on-chain exchanges. For that reason, your average customer that comes through a trading UI wouldn't always interact with an actual order because those would be picked up by the bots first. And we eventually discovered this new model, request for quote system, that is essentially much more efficient for both consumers and liquidity providers. It's less oriented towards the bots. So the way this system works is I come in, I say I want to buy 100 Ether, and then a market maker behind the scenes will give me a
used to not be near as much money as it is.
Yeah, exactly. So they'll provide a quote, and then the taker agrees to it and can fill the order from there. So today, where we're standing is we actually have all three models still kind of working in parallel. We have this liquidity aggregation layer, we have the off-chain order books, and we have this off-chain request for quote system. And I would say all three of them actually still work pretty well, do a lot of volume. I think people dismiss the order books a bit because it's not as visible to end users. They are mostly consumed by bots, but they still, generally do like $50 million plus in volume every single day.
Wow. Yeah. So I think that's one of the big things people tend to not realize about 0x is how it combines these different methods of quoting and providing an interface to traders. And then I want to dig in a little bit to like how Matcha started to fit in with this, because you mentioned originally, Will, your idea was let's do just a product, and then y'all kind of shifted to say, well, there needs to be something much more expansive, so like at the API level. And then Matcha was, hey, well, here's a product using our own, and then also it works as an aggregator. So if the 0x API is the best price for the person using Matcha, it'll use the 0x API, but it may also use Uniswap v2, SushiSwap, Bancor. I had an order filled today with Uniswap v3, which I thought was cool. I didn't have to change anything. I just used Matcha. So how did y'all decide, like, we want to actually be a user of our API, provide that product interface, and then blend all these things together, for the trader?
Yeah, good question. So it was kind of like a natural transition for our team. We had spent like the first 3 years purely focused on developing 0x as a developer platform, an open platform, and our customers were developers that are spinning up new markets. And what we ultimately learned is that it's great to empower other developers, but we also want to be able to build a relationship with end users, and we also want to be able to kind of, as you can imagine, like our team had so many like ideas for products that they wish we could have built for like years and years. Like, when are we going to build something? And so it kind of made sense for us to eventually kind of dog food 0x API by building our own end user product. And it was also just a really great opportunity for us to, get to reach out and provide a product to end users and like learn about end users, like their behavior. And yeah, I would say like we probably learned more about our own products that we're building since we started building Matcha than like ever before. Like the entire 3 years or more that we spent before starting to work on Matcha.
In what sense? Was it just like because you realized the aspects of the API that you wish you had access to, or what?
When it's because when you're building an end user product, you're hyper focused on the needs of your customers, like the user experience. How does everything look and feel? Where are like the rough edges that are exposed from the underlying blockchain? And, when you see that, you want to, you provide feedback. And so our Matcha team was able to, identify areas to improve 0x API and kind of like where those rough edges are, and provide that feedback back to the other parts of our team, the team that's building 0x API, that's, our team members that are like writing the smart contracts. And so instead of kind of where for like the first 3 years, I think we were much more like technologists trying to build bottoms up. Like what is the most superior solution from a technology, bottoms up technology approach that can create great technology, but it doesn't necessarily, tailor the product to end users and their experience. Mm-hmm. So when we started building Matcha, it like flipped things on its head. Now, instead of being like a bottoms up technology developer, we're like a top down, how do we modify this technology specifically for end users and to provide them with like the best experience possible?
Yeah, that makes a lot of sense. And one of the things I found interesting is, I imagine this is also a beneficial experience for all of the other people that are using 0x API because, when you look at who are the top consumers, I'm on 0xtracker.com. This is for like of the protocol, I guess, itself. And if you look at like where volume is coming from, you still have a lot of other people that are tapping into the API. So like Matcha is, I think, probably the largest user of the protocol, but it's certainly not the only. And one of the other ones that tends to be a common user is another aggregator, so a competitor to Matcha in 1inch. Like, so they're calling on the API itself. So what's it been like to have this kind of mixed relationship where you're a product of your own API through Matcha, but then also you're still serving plenty of other products, including some competitors of Matcha?
Yeah, that's also a really good question. And if you click on like the apps tab on the left there, that gives like a good view of all the different apps that are pulling from 0x API.
Yeah, so like Zapper and MetaMask and some of these that people probably use in other ways, they're tapping into 0x on their trading interfaces as well.
Yeah. So how we're, I think our team's perspective on, are we, should we be like trying to compete with other teams or, how do we think about it? Ultimately, like competition is a non-factor. Like the opportunity size in the next few years is so much larger than, what it is today. Like there's probably maybe, a few 100,000 DEX users today. And yeah, there's a lot of volume, but like it's a drop in the bucket compared to what it's going to be in a few years. And if we're able to, like power a bunch of different products that are targeting all sorts of different segments of users, and providing a ton of different types of experiences and options. Like that's just going to help the space grow. And like a rising tide lifts all boats. We're just focused on like adding value and creating value.
Yeah, that makes sense. So what has enabled the volume to really kick up so much, y'all, do you think, on the Ethereum network, kind of despite the fees? And obviously we've seen it on other networks as well. So what do you think has led to this demand and this desire for people to trade on chain?
Selection is first and foremost, if I had to guess.
So like a centralized exchange, they just don't ever list your token, but you can go buy it off of an on-chain DEX.
Mm-hmm.
I think it's certainly started that way, like with yield farming, and you kind of had to be on-chain first to get access to those. And I think typically centralized exchanges have gotten a lot faster about listing some of these tokens, but I think yield farming kind of did kick it off. Like people started farming all these random things, and then all of a sudden everyone's using DeFi, and then all of a sudden it becomes like actually valuable to use a decentralized exchange because you need to rebalance from USDC to USDT or whatever to like get some higher yield somewhere, right? That created a lot of volume opportunity, which drew in more and more liquidity. And now it just kind of solved the chicken and egg problem. Now we're at the point where there's really, really good liquidity on decentralized exchanges, oftentimes even better than centralized exchanges. And there's a lot of volume flowing through as well.
What do y'all see as kind of the biggest problems that DEXs face today?
I think that fees on Ethereum are still the biggest problem in my mind. Really, really happy that we're starting to see solutions pop up and actually get used. Like Polygon is just like really, really nice to use. It's like less than a cent to make any transaction, pretty much. But on Ethereum layer 1, I would say fees are definitely the biggest issue. Today, on this very day, gas costs are like relatively low, but historically over the past couple of months, they're probably averaging like 10 times what they are today. You need to make you need to spend like $100 or $200 in transaction fees just to make a trade. Like that's going to price out a lot of users. And I think what people don't think about is how much it also prices out developers. It really constrains the design space of like what you can build, because you're like really, really heavily optimizing your contracts for gas costs and stuff like that.
Yeah, one of the things that I thought was pretty interesting as people went experimenting with BSC and Polygon and places where fees weren't insane was some of the strategies in yield farming where they did things like auto compounding or stuff where were these transactions that you just straight up couldn't do on Ethereum when you're paying like $150 a pop to interface with a smart contract. Do you think that as fees settle down and generally get figured out on ETH, that we'll see like an evolution of the yield farming strategies that exist?
I'm not confident that fees on Ethereum are going to settle down for like a very long amount of time. Like the amount of demand for block space is growing over time. The block size is not growing. And I just think like we're in like hyper adoption growth phase for crypto and DeFi in general. And it's going to take some big changes to Ethereum for it to be able to support more users, more complex transactions.
I guess I was thinking I'm counting kind of layer 2 type of solutions as part of what that means with Ethereum. I do want your take on layer 2. Let's get to that first, because like y'all just announced this thing with Polygon, the Matic chain. I've always just considered it more like of a side chain. So it supports EVM. It's ETH friendly. It's got that portability. But do y'all like, is Polygon in your mind an example of a layer 2 solution, or is it somewhere in between? And is this, you think, like the most straightforward path for scalability within the ETH ecosystem?
That's a provocative question.
Not intentionally. Not intentionally.
So,
but you did partner with Polygon, I guess, to to try to promote getting additional liquidity in that ecosystem. And I imagine this is something you'll do kind of across the board as if your thesis is basically layer 1 is going to be crowded for a long time, then it's like, okay, well, where are we going to meet our users where they can actually afford to interact?
Right. Yeah. I mean, we think that the future is a network of networks. There are going to be many different blockchains. Different use cases might kind of find their user base on specific chains. But yeah, ultimately there's going to be many different blockchains that exist in parallel. All of them have thriving ecosystems. There's not going to be a shortage of networks out there. When it comes to, someone's personal taste or like personal comfort level, when it comes to like the security guarantees associated with the specific network, I think I definitely understand where some of the conversations are coming from around, what is a sidechain versus what is a layer 2 solution? Are you inheriting the full security guarantees of the layer 1 Ethereum chain or not? But ultimately, it's a moving target, because all of these technologies, all these blockchains are going to be continuing to evolve and improve over time. And something that, might rely on like a completely separate proof of stake consensus system today, like could be, anchored to the Ethereum layer 1, security in the future. So for example, something like Matic, but ultimately like users don't care. A lot of users don't care. Like they are not coming into the blockchain space because they have like specific opinions about computer science, and like that. They're coming into the space because it provides them with the freedom to do something that they want to do and they can't do elsewhere. And ultimately, like if we want this space to grow, we need to onboard many users. And over time, things like the security guarantees of a particular network, either those guarantees will change or users will become more educated and they'll, choose where to, park their assets. But ultimately, like what's important right now is that we grow the amount of users in the space, because this technology is just so valuable and can provide value for so many people.
It seems like that lack of, I don't know what you call it, like basically the user not caring was really proven out with BSC, and like how popular BSC was from a pure transactions perspective, the amount of money that flowed there. And by all means, it's a fairly centralized side chain of Ethereum, and people flocked to it because there was opportunity or they could accomplish their goals, whatever those were. So I think that was a pretty good proving ground for that lack, that lack of care that the typical user was going to have for various centralization or security concerns. Where do you think? Well, how does 0x fit in? Not as it's like a 1, 2, or 3 chain ecosystem, but it's like 10 or 12. You've got several layer 2 solutions that most people that are like really bullish on Ethereum seem really into. The two big plays, both on optimistic and ZK rollups, Arbitrum and Starkware and optimistic and all those, plus the slew of side chains that have caught various levels of traction, certainly including Polygon seems to be one of the big ones. What happens with 0x and the 0x protocol broadly, as like you're trying to operate between so many of these? What's that look like, and what are the challenges that you face?
I would say the long-term vision is like 0x protocol will exist on, basically every chain where there's activity. And there would be like a central hub that kind of connects all these chains together and, kind of governs the protocol across all of these different chains. And, potentially that hub is like a kind of venue for trading as well. We actually developed a zero knowledge proof based, highly scalable, decentralized exchange ourselves earlier on, but decided to put a pause on it for now, and just focus on rapidly expanding to different blockchains and focusing on user acquisition. But yeah, I think that's probably the long-term direction at this point.
Does liquidity become a big issue as people spread out, you think? Or will you think it'll be buffered by the fact that there's just more users in general coming on chain?
I think it becomes an issue for AMMs more specifically, because AMMs are, the ability of an AMM to offer good prices and decent depth for a given market is pretty directly tied to the amount of assets that are kind of locked up in that market. And if you have 20 different blockchains, each with, a market for ETH DAI or something like that, that's going to fragment liquidity quite a lot. But for something like 0x protocol, where, professional market makers are highly capital efficient, and 0x protocol, doesn't necessarily need to be limited to trading, between an asset, two assets that exist on the same chain. Like 0x protocol could be repurposed to do things like cross-chain trades as well.
So if somebody wanted to fill like $1 million order, let's go big and say like a $5 million, $10 million order. I think those are certifiably big in on-chain terms. It could basically choose wherever the liquidity existed across chains at some point.
They could. I wouldn't be surprised if the market makers are the ones that are doing all the legwork behind the scenes to make sure there is liquidity available where there's demand for it.
So they
exactly.
Go ahead, Amir.
Yeah. So in this scenario, let's say you're making a $10 million trade and there's $2 million worth of liquidity spread across or on 5 different chains or something like that. I think what's more likely to happen is you would make this big trade with like a single market maker, and they would be hedging on all these other blockchains behind the scenes, or wherever they're able to find the best liquidity. And from an end user's point of view, they're probably getting the same or potentially even better price than they would if you were trying to spread that across chain. Just because the end user doesn't need to deal with all the kind of cross-chain complexity and synchronization issues and transaction costs and stuff like that. That's all handled by the more sophisticated.
If somebody wanted to make an order like that today, is that the type of thing? I realize it wouldn't be cross-chain and all that yet, but cross AMMs or whatever other sources they want to provide. Is that what would be fulfilled by the RFQ system in your API?
Yeah.
It could be completely fulfilled by an RFQ order, or it could be partially fulfilled by an RFQ order and partially fulfilled by other sources.
How are the how are those market makers brought on? Who manages those relationships? Like, what's going on in the back end to onboard market makers and liquidity providers for those more obscure quote filling systems? Because it's not like here's all the tokens in an AMM contract and you know exactly what the depth is and how much you can get filled on and all that. This is more like, ta-da, here's your fill, through this quote. So what's happening on the back end of that?
Yeah, so we work with several professional market makers. We have a full team kind of dedicated to working with them and onboarding them and improving the developer experience for them, working on like new liquidity models and stuff like that. They're like definitely one of our most important customer bases. And always just working to onboard more and kind of grow the overall 0x volume opportunity for them. But yeah, at a kind of technical level, the way it works is, you request a price from the API. I say I want to buy $10 million worth of Ether. That will search all the different on-chain sources, as well as all of the market makers who are plugged into the system. And the market makers will return the best quotes they could provide. And then, our routing will kind of optimize the path between the market makers and the on-chain dexes and, spit out the best price. But yeah, I would say, for the pairs that these market makers support, like generally they're providing the most competitive pricing. And the other benefits you get from these quotes is that there's guaranteed zero slippage. You can't be front run or anything like that. You're just going to get the price that they quoted you.
Is that operating on Matcha today? Like if I just went, do I have to go to a special page or is that just right on the main thing? Like if I said I want to sell $10 million of ETH or whatever, it's going to run through all the various options today, right?
Yep.
Yeah. So you could check it out. We also, for 4 pairs, we rolled out a new feature. There's now an OTC tab. So that will just guaranteed go to the market makers. It won't even search the other dexes. And that's, if you want to make a big trade and you want to make sure you're not going to, get any slippage, you're not going to get front run, anything like that. That's a tab you would use. And just pulling up, if you go to like ETHUSDC,
I'm on
you could
ETHUSDC
check out that
now. So there's a OTC tab, and then I would connect to MetaMask, which I don't want to do right now.
yeah, understandable. But yeah, right now, you could buy $10 million worth of Ether through this OTC
straight
tab.
through that OTC tab. Okay,
yeah.
That's super cool. How competitive is that with, say, like if I have a relationship with an OTC desk? Like, is this going to be pretty similar, or what? Have you done any comparisons on that kind of stuff?
We haven't done direct comparisons by like hitting up the OTC desk and be like, hey, what? How much would it cost for 10 million ETH? Oh yeah, no, thanks. We're not interested. We actually haven't done a direct comparison, but I wouldn't be shocked if something like Matcha OTC is providing better pricing because we're simply matching supply with demand. There, OTC desks, there's a lot of like legwork that has to be done in order to execute large orders.
Yeah, they have to seek out the counterparty, basically.
Yeah,
or be willing to
charge
sit
a
on
premium
it
for that,
or be willing to sit on it themselves. But typically, they're going to have a counterparty that they find for you, so that makes a lot of sense. What kind of testing have you done in terms of what size order can go through those types of things? What type of slippage, or not slippage, because you said it's not, what type of discount do you basically have to provide on the order in order to get filled on some of those large sizes?
Definitely depends on market conditions and, your trade size and stuff like that. Right now, Matcha is quoting me for $10 million of Ether, it's quoting me $2,401. And it looks like the best offer on Coinbase is like $2,400. It seems really good.
Yeah. Well, that's pretty good. Yeah, I'm looking at another browser to where I actually have MetaMask connected, and I'm pretty impressed. I didn't realize this was a thing, that it was like I could do that right now on some of the major pairs. But that's super cool.
I think one of the big value propositions for Matcha OTC trades are, maybe if you went and got a quote, for a market order that is combining all sources of liquidity, maybe the quote would perhaps be slightly better, maybe, but you are running the risk of being front run or sandwich attacked if part of that order is being routed to an automated market maker. Whereas if you do a Matcha OTC order, you know exactly the price you're going to get, and there's no, nefarious third parties that can do anything to, mess around with your trade.
I want to dig into the issues trading with size on chain in just a minute, but before we do, how you said there's 4 pairs right now where the OTC trading exists directly in Matcha, but what's the kind of framework there? Like, do you think this will end up being on like the top 20 or 40 or 100 DEX pairs, or
so right now I think it's just like ETH USDC, ETH USDT, ETH DAI, and ETH WBTC, I believe. Those are the pairs we just know have really good and competitive liquidity. But yeah, I imagine it'll roll out to more. We just released this feature about a week ago, so it's still relatively early, and just want to make sure there are no kinks in the system or anything like that.
Yeah, that's awesome. I look forward to using it, especially like I trade a lot, so sometimes I'll switch my bias between like ETH, USD, BTC in a market like we have now where it's precarious, and you're just playing dominance back and forth from each other. So being able to get filled on chain with some relative size and not be worried about sandwich attacks and stuff is pretty awesome. So can you like just teach the audience a bit about like the attack vectors for on-chain trading? Maybe sandwich attacks seem like the biggest thing happening right now, but also potentially what other stuff is out there that, the people are playing with in the dark forest to try to make money off of on-chain traders.
Yeah, I think sandwich attacks are probably the main one. I've seen these on Binance Smart Chain, Polygon, like they're pretty sophisticated bots on all of these chains doing it now. So the way that works is, let's say I am making a trade on Uniswap and I set my max slippage to 1%. I submit my transaction, and the bot sees, okay, well, this person is willing to pay 1% more. So I'm going to front run this user, push the price up by 1%, so that they pay, basically the worst price that they're willing to pay. And then immediately after they get filled, I'm going to sell it back to Uniswap and basically, lock in some free profit. So they do both like a front run transaction and a back run transaction, hence the sandwich attack. And
that's that's all in one block, basically, right? Because it doesn't have to be organized in a certain way to occur. Like, is this? Yeah, continue on.
Yeah, so it all happens in one block, and then there's like new technology that has made it even easier to provide some guarantees for these bots. So there's a project called Flashbots where you can kind of bypass the regular Ethereum fee mechanics and kind of like bribe miners directly to create like, or to mine specific bundles of transactions so they can get like really strong guarantees that they're going to get a transaction in immediately before and after the trade. in the same time.
And the example that Amir provided is like relatively tame, like the 1% slippage. Hear horror stories about people that are trading on like less liquid pairs. And in order to do a trade, that isn't very tiny, they have to set slippage to 10 or 20%. And they'll get attacked, and more or less 10 or 20% of the trade proceeds are more or less extracted from them by these bots.
Do y'all have a lot of familiarity with Flashbots? Like, is there a way for traders to win or bypass or participate in order to get through some of this stuff? Or is it just kind of a problem with the ecosystem that's difficult to solve?
Use Matcha OTC so that you get a price locked in, and
I didn't mean it for
no minor extraction.
Good.
there are like a number of interesting solutions and around minor extractable value, and there's a lot of like really interesting work going on in that space. I think like without getting too deep into the weeds, what I would highly recommend all users or all viewers do is go to matcha.xyz and click on the OTC tab so that you get exactly the price you're quoted, 0 slippage.
I'm not going to argue that. One of the types of trades where I guess it was the most common way to trade on DEX before, and then with AMMs, it basically went away. And now it's kind of slowly coming back, is limit orders, right? Because, previously it was here's what I'm willing to sell for, and someone comes in and decides that they agree to do that on the old, like, order books on chain type of system. The AMs, though, are just these liquidity pools where everything just splashes down and you get what you get. And it's always kind of a taker system for the person making the trade. Now, y'all have an option for limit orders. There are other options where people do limit orders. It seems like there's different takes on this, and I'm curious what it's like, because this is one of the ones where it's been I've had some good, like perfectly good experiences on Matcha, and some where I didn't get filled because I didn't get like exact price matching. So it seems like that was kind of y'all's mandate with how you structured those. And there's some places that you can go, and some aggregators, like I think 1inch operates this way, KeeperDAO's trade mechanism operates this way, is where basically as soon as your limit order becomes a good enough arbitrage for someone to make money while filling your order, then they'll fill it. So, but you just don't have a guarantee of getting the best price or like exact match. What are the approaches to limit orders? What the heck's going on in that landscape, and why have y'all chosen to approach it the way that you did?
Yeah, so that's actually fairly similar to how limit orders work on Matcha too. So, I create a limit order, and there's just an open market for arbitrage bots to come in, and they're going to fill it whenever it's profitable for them to do so. But the side effect of that is that you're not going to get filled at the exact price all the time, because let's say gas prices are really high. Like if I place $1,000 order and it costs $200 in gas to fill my order, well, I'm just never going to get filled, right?
Okay, so when it doesn't fill, it's typically because like some elastic component of that equation like makes it to where it just doesn't meet the criteria.
Exactly, and it's like pretty difficult to explain that to end users, I would say, and I don't think there's really a perfect system for it, but generally, moving limit orders to more scalable solutions where transaction costs are lower, they're going to be much more reliable.
So what do you think is the future for limit orders in the ecosystem, and like an on-chain ecosystem?
I think limit orders are extremely valuable. I think solutions like AMMs are ideal if you just want to get liquidity and you're not very sensitive to pricing. You can go to an AMM, and you can consume liquidity whenever you want, just in time. But there are some people that do want to set the price that they're selling their assets at. And, I think that is something that many traders want to be able to do. So I anticipate that limit orders, all forms of different liquidity are going to exist in parallel, and it's just going to create a healthier market in general. But limit orders specifically, I think that, especially with more scalable networks, they're going to become more and more commonly used.
Yeah, that makes sense. Another element that I've run into with limit orders on chain before is basically they will only fill what they want to fill, right? If it's someone coming in and triggering this as an arbitrage. So say you set a limit order for like 100 ETH, you might get filled for like 98 for some reason, so traders, I guess, have to have the kind of different expectations for what they're actually going to get filled on, because it's not an order book system. It's not the same as a centralized exchange. Have y'all seen that, or is there any workaround that you know of to be able to basically get like kind of complete fills on things like that?
Yeah, I have seen it. Theoretically, you could have different like limit order types. Like you could potentially have like a filler kill type order where it's like 100% or nothing. But maybe, it's harder for our arbitrage bots to kind of manage that. Overall, I would say there are a lot of really interesting things you can do with limit orders if gas costs aren't an issue. like back in the day, I remember it was like 2018 or 2019, way before its time. I remember we released margin limit orders where you could actually like place a limit order, and when that was filled, it would actually like borrow the funds in that same transaction to fill the order. So you could like essentially trade on leverage with limit orders. It was using the DYDX smart contracts, but like those never panned out because one, I think it was before its time, but two, I think it costs like $1 million gas to fill those orders or something. That's just like never going to be feasible. But yeah, you could also, conceivably have like filler kill orders. You could have stop loss orders, stuff like that.
Yeah. Earlier this year, it was extraordinarily painful trading on ETH layer 1. Like the fees that you could pay were just extraordinarily. I don't recommend any active DEX trader to go to fees.wtf and see what they've actually paid, because it got pretty brutal. Which leads me to ask: do you think that the majority of 0x protocol trading will actually be on non-ETH layer 1 trades in the near future?
It's a tough one.
I think the number of trades probably will be higher on non-ETH layer 1. Actually, I'm pretty sure we have more trades on Polygon since launching on Polygon than we do on Ethereum.
Wow!
But in terms of like dollar volume amounts, like it's still much, much, much higher on Ethereum. And I kind of envision it being the same thing. I like this analogy of like, Ethereum being a big city, and then there are like all these suburbs or whatever where like cost of living is lower, but maybe you're giving up some of the advantages of a city. And I think for like really high value transactions, people will probably use Ethereum because it just has the highest security. Mm.
That's interesting. Let's dig into the ZRX token for a minute. The token itself launched in 2017. I think y'all did an ICO or some kind of token generation event. You had investors that received tokens. Y'all are backed by some of the pretty big names in the ecosystem. And it was one of the earliest efforts, I think, at like a raw governance token. And it still meets that criteria today. Like y'all still have more active on-chain governance than you, I think, ever had before. What's the main use of the token today, and how do people participate?
Yeah, good. So good questions. So we did do a token sale back in 2017. And actually, one thing that I think is worth noting, that I think we ran that in a pretty interesting way, where everyone that wanted to participate had to register up front ahead of time. And what we did is we basically set the amount that we wanted to raise based on how much funding we felt that we needed to see the project through. And then we divided that amount equally up amongst all of the people that wanted to participate. So we guaranteed that, anyone that wants to participate can, and there's no, it isn't like a small handful of whales kind of scooping up all the tokens or anything. We wanted broad distribution. We wanted anyone that wanted to be a part of the community to be one of the earliest stakeholders.
That's really cool. I wasn't able to participate in the sale, but the first CRX I bought was actually like the very first day it ever traded, which was on Liqui. I don't know if y'all remember that exchange, but it was a different time back then. RIP Liqui. So y'all have been y'all had a pretty fair distribution of those tokens, and I guess a lot of your investors too are from an equity perspective as well. Like y'all did a $15 million raise earlier this year. But nevertheless, what's the primary usage of the token today?
Yeah. So when earlier in the conversation, we talked a little bit about how we kind of transitioned from building a product, a decentralized exchange, to a platform that would allow anyone to build a business on top of this platform. Anyone could, spin up markets on top of the protocol. It's an open standard. And one of the things that was very clear to us in those early days is Ethereum is in its infancy. This technology is going to continue to change at breakneck speed. And it's probably going to always be changing. And the smart contracts that comprise 0x protocol, they're going to have to change too. But smart contracts are immutable. So what is going to be necessary for this protocol to remain viable? It's going to have to be built in a way where parts of the system can be replaced over time and upgraded. But this is a key piece of financial infrastructure. So if you were to think about, having control over, I'm spacing on the name right now, but if billions of dollars are being moved through this pipeline of contracts every day, and there are dozens of businesses that are relying on this set of smart contracts, it's really important that the entity that has control over upgrades isn't a single for-profit entity or a single, small group of stakeholders. This smart contract system is critical, and it needs to be controlled by a broad set of users and stakeholders. And so, even in the white paper that we published in February 2017, we made it very clear that governance is going to be super, super important for smart contract systems in the future. We're just not there yet. So it just doesn't feel important yet. But, if you think about, who has the ability to modify the compound smart contracts where there's billions of dollars inside of it, it's of course you need to have governance. It's a no brainer. So first and foremost, we knew that governance needed to exist. But ZRX was never purely a governance token. We also, knew that the token had to provide more utility beyond governance. And so actually, when we first launched, the token was actually a payment token. And so the intention was that these relayers, these entities that are, allowing people to post off-chain orders and then, broadcasting those orders to other people, they would be able to collect fees denominated in the ZRX token whenever, a trade is completed. But, I think we were like pretty naive at the time, and, very quickly learned that, someone that's going to trade on a DEX, they don't really care where the liquidity is coming from. They just want to go and do a trade. They want it to be simple. They want a good price. And the idea of having to, purchase a specific token in order to pay for a trade, it's just like additional friction for end users, and they don't want to do that. And so, we had to change the token economics away from being a payment token and governance token to being a different economic model and governance token. And with version 3 of 0x, which we launched, I think, in late 2019, the token economics changed. And they changed in a way, I guess it's quite similar to the economics associated with like an AMM almost, but I don't think people think about it that way for the most part, because most people aren't professional market makers.
Yeah.
But the protocol collects a small fee on every single trade, and the bulk of those fees go to professional market makers that have set up these pools. And those market makers are able to more or less like increase the amount of that fee revenue that they capture by sharing some of it with token holders that stake their tokens with them. And so, there's some complexity in terms of the finer details, but at the end of the day, what it ends up doing is the protocol rewards market makers proportional to the amount of kind of liquidity they provide in the system. And it rewards token holders as well with like a percentage of kind of all the fees that are generated.
Are token holders essentially agreeing to like almost like bond their tokens to a particular market maker, or do they just stake them in general?
The former. Yeah, that's correct. So they, if you have if you have some ZRX tokens, you can choose to stake them with one, or, you could spread them out over multiple different market makers to share in their fee revenue.
Gotcha. So go ahead.
Also, by delegating to a market maker, you're also giving them 50% of your voting power in the system, and then voting power can be used to like govern this treasury in the DAO, currently valued at $10 to $12 million. Yeah.
And then voting on top of that would be people that make a proposal to say, here's what we want to do with the treasury, and all the people that are bonded to those market makers or whoever delegating those votes, they essentially are the ones who would vote on what to do with any of those funds or how to make broader changes in the protocol.
Yeah, that's right. And it could be anything. They can make any change they want, including like changing the economics. But yeah, Amir made an important point around how kind of half of a token holder's voting power is given up to the market makers. What this ends up doing is that it gives the market makers that are creating value for the protocol and the token holders, it gives those market makers a lot of influence over decisions. And that's important. It's important to avoid token holders, trying to push through changes that could be kind of purely extractive or that would, basically do damage to these teams that are directly creating value for the protocol.
Yeah, that makes sense. So in terms of the changes that they could make, like, do they have direct control, for instance, like on what the fee would be that a market maker receives when they fill a trade? So like what the protocol charges to if someone's getting filled through the 0x API on MetaMask or something, they could change the fee that feeds back to the system?
So yes, there are basically two different ways in which governance occurs today. Right now, changes to the way the protocol works, those changes are determined by token holders the same way that any other change would occur, except instead of having those votes happen on chain and be binding on chain, such that there's no way for anyone to kind of like prevent a malicious thing from going through. Instead, people vote off chain, and then there is a kind of like a multi-sig contract that goes and executes those changes that the community has voted to approve. And obviously changes to the protocol are very security sensitive. So we want those to be binding on chain. We don't want to have, any, points of control. But we also want to be careful about transitioning that power over to, being binding on chain. When it comes to the community treasury is just a pool of financial resources that is controlled by token holders. And right now it's like a big chunk of ZRX tokens and Matic tokens, and token holders can do whatever they want with these resources. And the votes on how those resources are used, those are binding on chain. So there's literally nothing that we can do or anyone can do to stop token holders from spending those funds how they want. And, I think something that would be a pretty intuitive change in the future is a percentage of all kind of fees that are generated by the protocol should be diverted into the treasury. I think that would be like a pretty natural change at some point in the future.
Yeah, I think that would be really cool. And then another thing that I brought it up in the 0x Discord at one point, just asking like if it was possible, would be, this is just my dream scenario, right? Like essentially there were two things that I felt would make sense: supporting 0x's own life on chain. One was to essentially incentivize liquidity, people who provide liquidity on chain for 0x itself, by like accepting the liquidity tokens as a stake in its own right. I thought that would be really neat. I can't remember the other one, but I had another idea too. Yeah. Those are the types of things that people could propose in a governance vote.
Yeah, we actually have a governance forum, and I think I had a topic on a similar idea back in the day where you could stake with either like LP tokens or like compound or Aave tokens and kind of take advantage of multiple things at once. I think it's a interesting direction to go. But yeah, I think generally there's a lot of room to expand the economics. So when they were first introduced, it was like end of 2019 or so, quite a while ago. At that point, the predominant liquidity model within 0x was only these order books. So that's where the fees are being charged today. But since then, aggregation has been introduced, RFQ has been introduced, and they're starting to make up a very large proportion of the volume. Probably, I don't know the number off the top of my head, probably 80-90% of the volume. And there are actually no fee mechanics on those particular trades yet. So there's a lot of discussion on our forum around how fees would flow in and out of the system across like all the different liquidity models.
So if there eventually was an added fee for people that are using those tools, then that would funnel back, or theoretically, if it was voted on, that could like funnel back to the primary treasury and then be used to in whatever way that the token holders vote.
Yep.
Yeah.
I think one of the weird misconceptions of 0x has been, one, that there's never been any kind of token value accrual model in the system, or avenue for being able to establish further token revenue or revenue to token holders. And then the other, I guess, was that governance wasn't like a significant operating factor in what happened. And I've seen, Will, like you've every now and then like gotten heated up on Twitter and started responding to people like, well, here's where you can go to look at this and see like how you can make these proposals or see the token value accrual models that exist. And in comparison, like in Uniswap, for example, like there is no token value accrual today. Like they make a ton of money, but there's nothing that establishes this in terms of like where that money goes, like rewarding token holders. So there seems to be like a significant discrepancy in terms of how these various tokens work in DeFi, and then like where the revenues go from those protocols and who has control over that stuff. Is there any other like clarity that y'all would like to provide in terms of what's possible?
What's possible for anything in particular?
For a protocol like this where it's open governance and it generates revenue as well.
Well, that's one of the really exciting things about DAOs. And one of the reasons like we've been super excited about the idea of DAOs, for years now, is that, it's a group of people that can be located anywhere in the world, that can be anonymous. And they just, happen to have, they have an internet connection and they can coordinate to decide to do anything they want. So, and this community of stakeholders have control of a vast pool of financial resources, and they also have control over a piece of financial infrastructure, and they can make changes to that. And so I think that, anything is possible. Like, and that's like one of the things that's going to be so exciting about watching DAOs as they start to mature in the next couple of years is DAOs are going to start doing all sorts of like interesting and wacky things at times, I'm sure. It's going to be like a really interesting trend to keep eyes on. But as far as like the ZRX token and the economics and the treasury, I hope that stakeholders focus on what can we do to have the largest impact long term. We have all of these financial resources at our disposal. We have this amazing piece of technology that can literally change the world. It can disrupt the way markets currently work, and it can allow new markets to form where they never could before. And I hope that the stakeholders would see the opportunity long term rather than focusing on, squeezing out like some small, farming gains or something over the next 3 months or whatever it is, and then kind of fading into, just kind of fading away.
That makes sense to me. Amir, anything you wanted to leave us with as well before we head out?
Just want to reiterate what Will said. Like, literally anything is possible with the smart contracts. I hope people understand that. I think one of our challenges has always been that there are many moving pieces in 0x. And I think it's harder for your average person to understand all the things that are happening and that could happen with it. I would love people to keep an open mind, get involved in these discussions, and actually drive the protocol forward as much as possible.
Awesome. Well, I have to tell you, I really appreciate y'all spending time with me and describing more of the mechanisms of the project to me. I've been a fan of the work that you've been doing for a long time. As a trader, I've always liked trading 0x. It's fun on my side. I know that's not, y'all are long-term holder only type people for the most part, but it's a project where I really like to be able to trade stuff where I understand or I believe in the technology that underlies it before anything else. So I've been admirers of the project, and then of course, I know y'all sponsor the podcast as well through the Matcha brand, which I think is like a best in class DEX. It's one of the easiest things for me to be able to promote as a podcaster. So it's a fantastic product, and I appreciate both of y'all being with us today. If people want to learn more, you can go to zerox.org. They have kind of all the details about the protocol and information on that there. And then, of course, links off to Matcha and everything else that you may be interested in. Thank y'all both so much for being here. And I guess we'll catch everybody next time.
Awesome. Thanks so much, Brian.
Thanks. Have a good one.
Monuments crumble,